Class example 4, the assessment of risks. So you had 4.5 minutes reading time. This is what you should have picked up. Cars Limited manufactures and sells cars. So as soon as I see that they manufacture, I'm going to put a risk at the assertion level with regards to the valuation of their inventory, specifically their finished goods and their work in progress, because they have to assign costs to those being manufactured, and it is a little bit more complex than if they had to just purchase a car. This is the first year that Cars Limited has agreed to be audited. So this is a first year, so I'm going to say pre-engagement for sure, but it also means they haven't been audited in the past. So I've got a risk at the financial statement level that opening balances are misstated because they have not been audited before. Raw materials used in the manufacturing process are purchased from automotive part manufacturers all over the world. As soon as they're purchasing all over the world, we've got two risks. We've got at a financial statement level because of foreign regulation, potentially not being complied with, and then we've got at the assertion level for purchases and for our creditor. In terms of our purchase, we're going to have a risk with regards to accuracy of the translation, and that's the same for your creditor. And then you're going to have cut off for goods in transit. If this is over year end, there's a risk that they've purchased, risks and rewards have transferred, but they haven't received the stock yet. So they don't record the goods when in fact they should. Okay, so cut off, or you could say completeness. During the year, the CEO of Cars purchased a local automotive part manufacturer in order to ensure a shorter lead time in receiving raw materials supplied to Cars. So the CEO is related to Cars, has gone and purchased a supplier so that they can now use that supplier. So we've got related parties. So we've got risk at the financial statement level because related party transactions might not be at arm's length and they might not be disclosed. Guys, the reason why we say it's at the financial statement level is because there isn't just one related party transaction that we're dealing with. There could be multiple related party transactions affecting different balances and transactions. So that's why the risk itself is at a financial statement level, because you don't know specifically what transactions. In this situation, we can now go and add for raw materials at the assertion level. There's a risk that they are valued incorrectly because of the related party here. Right, so there I can pinpoint a related party transaction because they purchased raw materials, but there could be others that are not at arm's length and not disclosed, because that's the whole risk with related parties. Cars Limited's new computer information system was implemented by top technicians at SAG. So now, new computer information system, risk at the financial statement level. Because of this new computer information system, there could be errors in its makeup, and also maybe staff don't know how to use because it's new. It was, however, implemented by top technicians who have tested the conversion and are happy to report that the changeover was a success. So here is one positive from the information system as part of internal control, is that it has been tested and it appears to be working. However, it's by an external party. It's not by the auditors, so we can't just say that it does work. The auditors haven't done the testing themselves. Okay, so that's what you should have picked up in your reading time. Not knowing what the question is asking, I made a note based on what I saw. Now I get to my required. Assess the risk for the audit of Cars Limited for 15 marks. Okay, so let's break up this required. Assess the risk. So you have to do some analyzing here. So ultimately you want to identify risks and then discuss them. But also, because you're assessing, you might also want to identify controls that decrease the risk, so that you can ultimately explain there is a risk here, but this assists the risk. I'm not going to say the risk doesn't exist. I'm trying to explain if this risk is valid. For the audit, so they have now said audit risk essentially, and that means we've got inherent risk, control risk, and detection risk. We have addressed these two in the lecture. Detection risk now we were only leaving for next week, the risk that the auditor doesn't detect, and that's got to do with how they're going to respond. So if there's anything that you can pick up for here, do so, but otherwise we'll look at that next week. So going back to now what you've identified, because that's your starting point always, guys. You always want to put down the risks that, or whatever type of question you're being asked, anything that you picked up that links to that question in the reading time is what you want to start with, because you want to get marks immediately. So in order of picking them up, you need to go and discuss. Guys, here you can see you have not been limited to assertion level or financial statement level. So ultimately you can do this for both. Alright. So the first risk that we picked up here, risk at the assertion level because they manufacture. So you're going to say there's an increased risk with regards to the valuation of the inventory as a result of their manufacturing and having to determine the costs. Second risk, there's a risk that the opening balances are materially misstated because they were not audited previously. So you don't even have somebody's opinion on them, and so they could be materially misstated. Third risk, risk at the financial statement level, foreign regulations. Because they import, there's a risk they do not comply with the foreign regulations, which could result in misstatements to the financials. Fourth risk and fifth risk, risk that your purchases are, or your foreign purchases are translated at the incorrect exchange rate, and risk that any goods in transit at year end are not recorded. Sixth risk, related party transactions. Because the CEO who is related has purchased a supplier that is now going to transact with the company, there are related party transactions. So therefore there's a risk that they are not at arm's length, and there's a risk that they are not disclosed. Then there's the risk that raw materials are valued incorrectly because they are purchased from a related party. 9, risk that the errors because there was a new computer information system, and when it was implemented, anything that was supposed to come through from the old may not have done so correctly. And the 10th risk here, that staff don't know how to use this new system, so there could be errors in them trying to use the new system. And then we've got one positive here, that it has been tested, and then an external party believes that the conversion was a success. So I've now addressed the risks that I picked up in the reading time, but I've only got 11. This is out of 15. So I need to find 4 more risks. Before you start reading again to try and find risks, now it's important to see if there's any risks that you can expand on from the risks that you had identified initially. So, opening balances. we put one risk here. The risk that the opening balances are misstated because they were not audited in previous year. I'm going to now tell you there are 2 additional risks that you can add for opening balances. There's a risk that the opening balances are misstated because we were not the auditors in the previous year, so we don't have experience. That's the perfect place for management to then go and misstate because they come through from prior year, so you're not going to audit, you're auditing the current work. Okay, so it's a great place for them to go and fraudulently misstate. So there's just a risk that they misstated, and then there's an intentional risk that they misstated. In addition, there's now a detection risk for the auditors that they don't identify any misstatements in opening balances because it's a new company. They were not the auditors in the previous year, so they don't know about misstatements. Okay, and that's the only additional risks from what I had originally picked up. Guys, I'm going to leave it at that, and we're going to look at the solution because there are a few risks there that I don't expect that you would pick up just yet. We need to address that theory first. So, look how the layout is. Because it was assess the risks, we've got the following increase the risk, the following decrease the risk, and there's a mark to show that you will get for assessing. Okay, so easy risks, foreign regulations, and guys, a little bit further into why that is a risk with regards to the financials. First of all, if the foreign regulation impacts on the financials, then there will be a misstatement if they don't comply. But there's another one, is if they don't comply and they get penalties, or they're no longer able to operate in the foreign country, it could impact the ability for them to continue as a going concern, and that impacts the financials because if they're not a going concern and they prepare their financials on a going concern basis, the entire set of financials is wrong. Okay, so there's a few ways in which there could be misstatements by not complying with foreign regulations. But if the regulation itself does not impact the financials on its own, then this is how it could, through penalties for not complying, which could affect their going concern. Okay, opening balances. So, risk that they're materially misstated because there was no prior audit, and then potential intentional misstatement because we weren't the auditors, so we might not have the knowledge. And then the detection risk here, the auditors, first time, they might not pick up misstatements in the opening balances. Okay, this is a risk that I now want you to pick up going forward, but didn't expect you to get it then. Going concern risk because they're not complying with the Companies Act, because all public companies are required to be audited. They are cars, limited, public. So the fact that they chose to be audited now shows that prior to that, they have not been complying with the Companies Act. Right, if they were a private company and they didn't meet the public interest score, they don't have to and they can choose to. But they're public, so they were required to be audited. And the fact that they haven't previously means there's non-compliance with the Companies Act. Okay, so going forward now, when we see limited, I expect that you know that it's public, and I expect that you know they must be audited. Nothing more at this point. Okay, risk and management integrity is lacking, so the control environment is weak because they are not following the Companies Act. Okay, related party transactions and the new information system, there's a risk that your data is transferred incorrectly and that staff are not trained, don't know how to use it. But the decreasing factor, those experts who believe that it was implemented correctly. Risk at the assertion level, the accuracy of the purchase and the valuation of creditors if incorrect exchange rate is used, and the goods in transit at year end. Work in progress, value, complex, because they manufacture, so valuation, raw materials that are purchased from the related parties, value could be a concern, and then any liabilities because of their non-compliance. So we say they could face penalties. That would then be a liability that they would need to settle, and if they cannot settle that, it could affect their going concern. Okay guys, this is the type of question you can expect for 15 to 30 marks with the bigger scenario. That's what I want you to pick up in your reading time. Okay, let's finish the lecture. Sorry guys, I did miss this slide. This was before your class question. Just to cover if you are auditing a group. So how does that impact from what we've done today? Well, you're going to apply ISA 315 to the audit of the consolidated financials. So the group auditors need to gain an understanding of the group, its components, their environments, internal controls by performing risk assessment. Then the group auditors need to establish the overall group strategy, and they need to calculate group materiality as well as component materiality for the different components of the group. And guys, if the group auditors are not auditing the components, they need to give this to the auditors of the components, so the subsidiaries, and then the component auditors will then have their own performance materiality and now component materiality that they're working towards. So when there's a balance or transaction that is going to affect the consolidated financials, they've got to look at component materiality. And then the group auditors need to assess the risk of material misstatement for the group at both levels and find significant risks for the group. Okay, so to summarize, it's been a very big lecture, yes. We as auditors gain an understanding of the entity and internal control by performing our risk assessment procedures. Then we go and determine the audit strategy, the scope and the timing of that strategy. We go and calculate materiality, and we use our understanding as well as materiality to go and identify the risks of material misstatement, and that essentially is our direction of our audit strategy. Remember, the material that we're looking for there is performance materiality. So we calculate two materialities, but we're only using the one when looking for risks of material misstatements. What else do we establish from this understanding? From understanding the entity, internal control, and the risks, we establish the resources that are required for the audit, the experience needed, the number of staff needed, whether we need external resources like experts or cats. Okay. Types of questions you guys could get asked: discuss factors in the scenario that will affect the audit strategy, and we addressed that when we looked at audit strategy, but you're looking for the big things that help us to understand the entity and internal control. Calculate planning materiality, you've got to apply the steps. Identify weaknesses in the calculation, you apply the steps and then pick up where there's differences in the steps. Identify and assess the risks of material misstatement at the two levels. This is going to happen, no doubt, in tests and exams at both levels. Identify significant risks. So now those are just the risks at the assertion level that are very NB. And then identify and assess business risks. Guys, we didn't really touch on business risks. So I've just included a slide here to explain what business risks are. And all I've said is often you are required to identify business risks, not just significant risks or risks of material misstatements, but they've actually changed it to a business risk. And a business risk is exactly what it sounds like. For that company, what are the risks that that company faces, that business itself faces? And they're going to face many risks. And included in those risks are going to be significant risks, risks of material misstatement at the financial statement level, risks of material misstatement at the assertion level. And then there are going to be risks that don't affect their financials at all. And so they wouldn't be classified as significant or risks of material misstatements. They are risks that will affect their business because of the type of business that they are and the industry that they're in, but they may not impact the financial statements. And so business risks include all the risks that that business can face. So it is the biggest category, I would say it's the broadest of risks. If you get asked the business risk question, you could put any risk that you think that business could face, whether it being a significant risk, whether it be a risk of material misstatements, or it's a risk that doesn't affect the financials, but you can see that that would affect its operations or would affect the business because of its industry or because of its environment. Okay. I've just made a note just so that you don't freak out if you get asked for a business risk question. I've said most of the risks that the business faces will actually affect the financial statements. And so they would have been risks of material misstatement, whether it be at the financial statement level or at the assertion level. So don't go and think that now if you get asked a business risk question, you've got to go and find risks you've never seen before. The same risks you would have picked up for at the financial statement or assertion level will fit there. So you put all of those down first. And then if you don't have enough and you can see other risks that you wouldn't normally include as risks of material misstatement, you can then go and add them. Okay, so here's your tip. First include all the risks of material misstatements, and then if there's anything else that you can see as a risk, you can go and add it in. But you would generally get most of your marks by just putting down the standard risks that you are used to picking up, because you often get asked risks of material misstatements. Okay, so it's just a broader category. It just means that anything can go into your answer, as opposed to when you're limited to just significant risks or limited to just risks at a specific assertion, for a specific assertion or at a specific level. Okay, some pre-reading, guys. If you are able to, responding to risks of material misstatements, the audit plan, both of these you can actually find in ISA 330. All right, have a great week.